I think the calls for an intermeeting cut right now would freak out the market even more than it is right now. And I think we'll probably see, maybe if the data continues to come in weak, particularly on the employment side between now and the end of August, we might see 50 instead of 25 in September. But I'm not sure you're going to see the Fed reacting to this market dynamic right now. And as you were just saying a few minutes ago, we're more likely than not to see some people start coming in on the buy side now that you can buy Nvidia at a much at a welcome discount to what you were buying it for a few weeks ago.
Fair enough. Could get better, I guess, too, as we go. Christopher, I'm compelled by this whole narrative that Jay Powell has screwed up again. He was late to start, and he's going to be late to finish, when he might be sitting back smirking right now thinking that this was the point, that he wanted the market to capitulate, and he can now move forward with cutting.
It's the poor guy. He's either a dope or an evil mastermind, or a good mastermind. Right. More like, the truth of the matter is he's a really bright guy who's trying to make sense of some very complicated data at a very tricky time in our nation's history, right before a very polarized election. I think the one thing we do know about him and the rest of the members of the FOMC is they're not going to jump and react to a few days of trading in the equity market. I think they will pay extra attention to the labor data that's coming in, because that's what the market is signaling. I mean, are we wrong about the soft landing? Is there more weakness there than we think? Is that unemployment uptick because more people are coming out looking for work, or is it because the hiring is cooling down? The data still seems to show that balance sheets are strong, consumer demand is still good, earnings are weaker, but they were supposed to be weaker. Remember, they were cooling down the economy. That's what he was trying to do. So I guess, Joe, to your point, it does feel to me like he's more likely sitting back and saying, this is what I was hoping would happen, rather than, panicking.
Well, as you allude to the question of whether or not the soft landing ultimately is going to be realized, we did see Goldman Sachs and Jan Hatzius over there raising their recession odds in the next year to a still, I guess you could say, relatively low 25%. So we're talking 1.25% chance here. That's up from 15%. Right. Where would you put the odds right now, Christopher?
I'm sorry. Stop the presses. We've gone from 15 to 25%. And Jan,
they're still higher.
Jan is an extraordinarily talented economist and market strategist, so I'm pulling his leg a little bit here. But yes, of course they're higher. They're supposed to be higher. The economy was supposed to be slowing down. The unemployment rate is supposed to be ticking up. The prices, as you recall, which is what we were all focused on over the last year, are coming down, and that's the good news. Again, I go back to the market reaction that is causing so much uncertainty right now. And I think we all have to come back and re-examine our fundamental approach and our assumptions here. What did we get wrong? What is it we're missing? But the market dynamic here, again, I think tells you much more about the way people are positioned, the way that risk on trade people have sort of gotten way out, if I can use an unseasonal metaphor, way out over their skis. And a few worrying data points have sort of triggered this rush to safety. So I think I would expect things not to bounce back suddenly from here. We might get a few more weeks, days of choppy markets, but I don't think it's my base case or many people's base case that we're now suddenly heading into a recession next year. But we'll be watching the data later this week. There's ISM data. There's another jobs. The weekly jobs report, and that'll have a lot to do with that'll say a lot about where this market is headed in the near term.
Really interesting. So you talk to Christopher Smart for 5 or 10 minutes. You start wondering if maybe it's time to start buying. Maybe this is irrational. Christopher, what would this market look like with a rate cut under its belt? Go ahead and correct me if you want.
Well, I don't want to say you should buy today. I'm just saying things are much more attractive, and you shouldn't be selling today, probably, is what I would say. I think, again, we're sort of looking at, maybe 3, maybe 4 25 basis point cuts between September and January 1st. You start looking into next year, and, as long as the the hiring data, the corporate balance sheets remain strong. Credit markets still look relatively healthy, and you don't see any kind of. I mean, we're all sort of on the lookout still for those hidden accidents. Is it another regional bank? Is it an emerging market? Is it some part of the financial system that we can't see that is suddenly going to break under the stress of high interest rates? Those are all things everybody needs to keep an eye out for. But at least right now, I think it's hard to make the case that the data is saying we are headed for a recession. So I guess, my very tentative advice would be this is not a time to sell. And over the next few months, you'll be wanting to look to add.